What I'm going to do is to cover a number of the same issues that Professor McFadden just went through, but I'll do that in the context of presenting the new OECD economic projections for the near term that we published yesterday. Some of you may have seen references to these in newspapers today. Before doing that, just by way of giving a bit of context, let me show you a chart which compares three major economic cycles since 1970. The one we're currently in is the red line on this chart. What is shown here is a measure of economic slack. It's the so-called output gap, the difference between what the economy is capable of producing and what it actually produces. And you can see that in comparison with previous big cycles, the current cycle is one that is characterized by slack basically not closing. This is, by historical standards, a very slow recovery. If we look at the development in world trade, you get the same impression. Comparing world trade growth, these numbers are in levels, but comparing the way they have increased over the past year and a half to the way they increased before the crisis, you can see that trade has simply shifted down a gear. Again, an impression of this being a very slow recovery. So it's important to understand why is the recovery slow, also because that may give us some hints as to how it's going to evolve going forward. One of the reasons why the recovery is so slow is obviously that there is a need in many places to deleverage following the debt-financed spending binge that were undertaken in many countries up to the economic crisis. If we look at how things are going with deleveraging, I think it's fair to say that the US is further advanced in terms of deleveraging than is the case in the euro area. That goes if one looks at the banks. US banks today look better capitalized than European banks, insofar as one can make comparisons with all the caveats around accounting standards, etc. And if one looks at households, let me just show a picture here. This is gross household debt as a share of disposable income. You can see that in the US, household debt is coming down at a reasonably fast clip, whereas in the euro area, household debt has not yet started to decline. So adjustment following the debt-fueled spending binge has been faster in the US. The US housing market has also adjusted and is now showing positive price developments. When we then look at fiscal consolidation, clearly fiscal consolidation is one of the factors holding back economic growth. Too bad we have to undertake it, but well, there's no alternative. If one looks across the Atlantic, the situation is a bit different from private sector deleveraging, in the sense that the Europeans are actually more advanced in terms of fiscal consolidation than they are often given credit for. On our projections, euro area debt on average would begin to decline as a share of GDP just beyond our projection period, which ends in 2014. So the euro area is more advanced than the US, where debt is still expected to go upward. But within our projection period, we do expect fiscal consolidation to continue in both the euro area and the US. A third factor that has been a reason for slow recovery is, of course, the euro area crisis. It's not just the euro area that has been affected. The rest of the world has been affected through a combination of trade effects via financial markets, and effects via corporate confidence. Going forward, I think it's a fair bet to assume that at best the euro area crisis is going to be resolved only gradually. And in any case, that's the assumption that lies behind our projection. Finally, on emerging markets, one of the reasons that we have seen weak recovery is that emerging markets have slowed down, at least until the beginning of this year. There are sort of two reasons for that. One is a structural reason. Trend growth looks to be declining in a number of emerging markets. Exactly how much is not so clear. But superimposed on that, there has been a cyclical downturn in emerging markets. Basically, economic policy was tightened in order to control inflation, and lo and behold, inflation has come down in most emerging markets. That gives some space now for policy to ease up, and we are already seeing the effects in terms of a reacceleration in emerging market growth. So where are we now, and what are the prospects for the next coming months? One way of gauging that is to look at business sentiment. Business sentiment has stabilized in the euro area at a level that is consistent with continued recession in the near term. Japan is a case where actually business sentiment has not stabilized. It is still declining and also into recessionary territory. But in the US, and perhaps consistent with some of the notions I mentioned before, it looks to have stabilized at a level associated with sort of moderate economic growth. In the emerging market economies, there has been some recovery in business sentiment, and it now seems that business sentiment is consistent with moderate economic growth in all the emerging economies. So, this is our outlook, key numbers. There are way too many numbers for me to be able to go through them. Let me just give you the headline, bottom lines. In terms of world growth, we have revised down since our May projection by approximately 0.5%. So world growth for 2012 is now just below 3%, which is weak. The downward revision mostly comes from emerging market economies. For 2013, we have pushed out into the future the recovery in the OECD area. So we have world growth at around 3.5%. That is about 0.75% weaker than what we saw in May. And then for 2014, we have world economic growth accelerating up to just above 4%. So at that stage, we would begin to close output gaps. Let's look at the dynamics of this for the three major OECD regions. What you can see on this is that we have these are quarterly growth rates annualized. What you can see is that we have got a gradual recovery in both the US and the euro area lagging behind. Basically, the euro area is either in or close to recession until well into 2013, but then sort of little by little begins to emerge from recession. The US, as I mentioned before, looks more robust, and we see a sort of steady recovery there. Excuse me. I should say that for those interested in Italy, and I assume there are some in this room, the growth rates that we would see for Italy are somewhat to the south of those that we see for the euro area, but in that context, it needs to be remembered that trend growth in Italy is just very, very low. So one needs to keep in mind that a low Italian growth rate doesn't mean quite the same as, say, a low Chinese growth rate. Now, you will see that there's sort of a very odd profile for Japan. This is something that's created by an already decided very strong fiscal tightening coming into effect in 2014, and the effects of that on the timing of consumer expenditure, etc. Two important assumptions lie behind this projection, and they have already been alluded to earlier. One is that the euro area policy framework evolves just enough to model through. We don't know exactly what that means, but it means that no major risks will emerge in the euro area. No events will occur that are of sufficient magnitude to sort of give a jolt to the system. In that context, you can say what happened on Monday with the Greek debt and financing program sort of confirms that impression. This would seem to, at least for some time, have taken the issue of Greece off the table. Second important assumption behind our projection is that the US fiscal cliff does not materialize. We have put in a tightening of fiscal policy of 1.5% of GDP in 2013. There are different ways of adding the numbers for the US, but at least the way we add them up, the magnitude of the fiscal cliff would be a 4% of GDP tightening in a single year. In our way of calculating things, that would be enough to tip the US into recession if it were to materialize. So I think we're very much on Professor McFadden's line in hoping that that Congress will sort of get together and avert the fiscal cliff. For emerging market economies, as you can see on this slide, actually we have already seen a fair bit of recovery in growth rates. And basically what we assume is a little bit further recovery in growth rates in emerging markets, but then basically macroeconomic policy adjusting so as to stabilize economic growth at a level that does not pose inflationary problems. With these kinds of growth numbers for the OECD countries, clearly unemployment is set to remain a major issue, set to continue to rise in the euro area for quite some time to come, and is coming down slowly only in the United States. What about risks to the outlook? Well, of course, as I mentioned, the projection is based on two very important assumptions, and they could be wrong. So one risk to the outlook is clearly that the US fiscal cliff emerges, in which case the US would be in short-term recession. not enough to tilt the whole world into recession, but clearly enough to give a bad shock to the world. And the other risk is that the euro area, that something bad would happen in the euro area. Another two risks that are sort of small in this context is oil prices. We have tended to forget about them of late, but the Middle East clearly is a somewhat unstable place, and this is a risk that one wants to keep in mind. And then finally, and this comes back to something that Professor McFadden also mentioned, we're about to see, and it has already started, a transition in emerging market economies, both towards lower growth rates in China in particular, but also towards a different kind of growth, a growth process that is not driven primarily by investment. Currently, investment makes up half of Chinese GDP. As growth comes down, you just cannot justify such a level of investment. That means the economy has to adjust so that consumption drives economic growth to a larger extent. I would say on the external side, a lot of the adjustment has already happened in China. Their external surplus is down to 3% of GDP these days. But this reallocation from investment to consumption might be something that's associated with turbulence in the economy. How much time do I have, Chair? I can continue. All right. Let me just say a little bit about where we are in the euro area process then. Clearly, the euro area needs to do two things. The euro area needs to undergo an economic rebalancing, basically between the north and the south. The south needs to produce more exports. The north needs to rely more on domestic demand. That's one adjustment. And the second thing that the euro area needs is to put in place a financial and fiscal architecture that takes off the table a number of financial feedback loops that are now in operation or risk coming into operation. So let me just speak very quickly on those things. To look at the issue of economic rebalancing in the euro area, I think it is actually worth thinking about the euro area crisis as a good old-fashioned balance of payments crisis. I mean, like the Latin American debt crisis or prior episodes of that nature. Using that optique, this slide looks at what has happened to different countries' current accounts. And you can see that from 2008 to 2012, the current account deficits in a number of the countries under pressure has improved a lot. In Ireland, the deficit has even turned into a surplus. So there's been a tremendous improvement on the current account. Now, part of that improvement in the current account reflects that economic conditions are just so depressed in some of these countries. So to account for that, we have tried to cyclically adjust the current accounts in the countries that you see here on the slide to identify what is the underlying level of the current account. And that's the red bar. And you can see that, okay, the red deficits, the underlying deficits are still somewhat are visible, and they are certainly bigger than the green headline deficits, but they are still in general a lot lower than the blue bars. So there has been adjustment in the countries under pressure. And I think that's an important point. It needs to go further, no doubt about that. In order for it to go further, it would make life a lot easier if there was a flip side in the core economies in the north. But look at Germany. Basically, the German surplus hasn't budged. And I think there is an issue for the euro area. There's no symmetry in the adjustment between the countries that are under pressure and the core countries, or whatever you want to call them. Part of the reason that you have had this development is that competitiveness has begun to adjust. This is a slide which actually Professor McFadden showed a somewhat similar slide, but with fewer countries. Here there are perhaps so many countries that you can't really distinguish all the lines. Anyway, this is just to say that you can see towards the end here, and the period 2013-14 is our projection, but you can see there is a convergence in labor costs. This slide shows the development in the level of labor costs adjusted for productivity in the individual countries, and you begin to see a convergence. But obviously, there's still far to go here. There's a lot of adjustment that needs to be undertaken to allow the countries under pressure to gain market shares and to see more export growth. 1 minute. You're very generous. Let me just then say on what I mentioned as the second thing that has to happen in the euro area, which is one needs to neutralize a number of feedback mechanisms in the financial markets. There are three separate but interacting feedback mechanisms that are important there. One is that we have a feedback mechanism between sovereigns and banks. When banks look weak, there are expectations that the sovereign will have to intervene somehow, support the banks. That makes the sovereign debt prospects look weak. That leads to a higher interest rate on government bonds. That further undermines balance sheets of the banks because they hold government bonds to an important extent, and you have sort of a vicious circle there. Second feedback loop, exit risk and government bonds. If a country is believed by the markets to be in risk of exit, of course they will demand a high risk premium in order to buy bonds. But if the risk premium is high and interest rates therefore high, the chances that the country will exit go up. Again, you have a sort of negative feedback loop. Finally, if you have higher interest rates, and especially for countries that already have high government debt, that means weaker government budgets because of the direct effect of interest rates on interest payments by government, so there would be a direct effect of weakening the government budget balance, and there's also an indirect effect via the effect of interest rates on activity. So higher interest rates will make for a weaker government budget, which means higher government debt, which again will feed back in terms of higher interest rates. So you have a third negative spiral there. I think we have by now, and I haven't got time to go through it, we have by now identified the necessary initiatives to take in order to interrupt these feedbacks. And they are beginning to be put in place. But for as long as they are not fully put in place, then there's going to be risk of renewed financial turbulence in the euro area. My final point on this slide, and now I am going to end, is it really would be nice with some more growth. Hence, structural reforms are enormously important. It would be nice with more growth, both because the kinds of structural reform that boost growth, they also ease the real economy adjustment that has to take place, but also because higher growth just means that the debt dynamics become more manageable. So with that, I will say thank you.